our thing. Real life example from our group. Bad. Okay. So in Deutsche Post environment, yeah, sometimes we do have subcontractors, yeah. Their task is to support us with the pickup and delivery function. You people must have seen different DHL vehicles roaming around here and there, and yeah. So in Pakistan, I think most of the vehicles are somehow operated by our own couriers. But if I take the example of many European countries, yeah, many of these contracts are somehow outsourced to subcontractors. These are the basic somehow conditions which we usually lay down in a subcontractor contract, that first of all, like this contract will be for, let's suppose, maybe 3 years, 4 years, whatever. Usually we say, okay, the vehicles should not be more than 6 years old. Then we also say that vehicles have to be really the transport vehicles. Then also we say, like, vehicles need to be somehow put in with the yellow skin and the stickers. Yellow skin and stickers are not very expensive, so we provide them for free for the first term. However, if a subcontractor wants to buy another somehow package, then he has to pay certain hundreds euros or whatever. So it was like debated with PwC for, I think, many months. Yeah, the framework agreement was debated for many months. Yeah. So what do you think in this scenario, what would have been the outcome? Yeah. So how many of you think that must be a lease? Actually, I'm very surprised. At least in the beginning, I also thought it should be lease. And this is what PwC also thought, it should be lease. Oh, brilliant. Really brilliant, yeah. So you have to help me with, really, my left ear is completely blocked because of flying. You have to help me with a question.
Is to put that yellow logo or yellow skin back onto the vehicle. How easy or how quick it is to...
Yes, the skin, like usually you go to the mechanic shop or whatever, and just they put the yellow skin, and then if you want to remove, you can simply remove it. It's like, it's not really big cost, maybe 600 euros or 500 euros, something like this.
Would that then mean that it is pretty easy to replace one vehicle for another?
Yes, it can happen.
It's relatively easy, right?
Sorry?
Relatively easy.
Yeah. Maybe, for example, let's take an example like if the lessor only has one vehicle, because I cannot say if he has more than one vehicle, right?
Right.
My contract is only for one vehicle, but if he has only one vehicle, or if he has more than one vehicle, I will not be able to know. Yeah. Just I want to give you a bit of heads up that sometimes these discussions can be really challenging. You have to involve then, as a controllers, we have to really involve then the operational teams. Yeah, it's also one of the key learning point which I've somehow learned over the last 1 year. Yeah, you have to get closer to the operations. You have to get closer to the business. That what was the real objective to enter into this contract? Was it really a financing need? Why do you go for lease? Why do you go for finance lease? It's a financing option, right? Why do you want to go for an operative lease? Because you want really an asset for a short period of time. Yeah? Oh, I'm too bad. I'm sorry. What is... Unfortunately, I'm not really used to stand in one place and just talk. I'm more used to, revolving around and First, I think we have to fix this one. Okay, I think we have not too much time, yeah, so I have to show you the slide. So actually, in the end, we were able to convince PwC that it's not a lease. Yeah, because how we were able to do that was that then we started talking to the operations people, that what was the real reason to have these contracts. And that was mostly the operational reason, yeah. We wanted to have a flexible cost structure. Yeah, we are not sure that if this customer is going to be there for the next 3 years. So we wanted to shift our risk to the lessor or to the supplier or to the subcontractor, yeah. Another thing is like we have drafted the framework agreement in a way that he was compensated based on the number of stops. Variable rentals were much higher, yeah. And then the other question was that why do we have to specify the vehicle and logo and these kind of things? And it was because more like a protective right. Yeah, so we wanted to save our brand in the eyes of the customer. Yeah, we wanted to always have him see the yellow vehicle. Yeah, that was more to protect our brand. It has nothing to do with the service quality or the service level. Yeah, it was more to protect the brand. Yeah, so in the end, we were somehow able to convince PwC that it's not a lease, it's a service contract. Okay, so why this somehow classification is so important? Any idea? So you can have a contract with a service element, or you can have a service element with the embedded lease component. So why do we have to separate service contract, service element from the lease component? Any idea? Simple answer is that service contracts do not meet the recognition criteria of an asset. Under the conceptual framework of ISP, service right to receive a service does not meet the definition of an asset. So you cannot take the future service contracts on the balance sheet. However, in a lease contract, you have a physical, or at least you have a right to use a certain physical asset, yeah, or a portion of a physical asset. That is the reason, yeah, we have to somehow separate the service element from the lease contracts. Agreed? And for the service contracts, you have to apply IFRS 15. Okay, so how we can do this somehow separation? There are certain criteria which are laid down in IFRS 16 and IFRS 15 also, like basically there is the standalone price, then also like residual approach is also there, where you try to estimate all the elements which you can, and then the balance is somehow assigned to the service element. For example, if you see, okay, yeah, so in this case, you can see, for example, the standalone contract for the aircraft is, let's suppose, 300K, and overall we are paying 600K. So you try to apportion the real lease contract with all these elements, and you try to apportion that into different elements. Yeah. In the other side of the slide, you can see that we have followed the residual approach. It's just to give you an indication that this classification is also required, and the service element need not to be on the balance sheet, or it has already been laid that it should not be on the balance sheet. Only thing is, like, there is a practical exemption. If the service element is immaterial to the overall contract or to the overall financial statements, then you do not have to really separate the service element from the lease component. Yeah. For example, if you want to lease a vehicle and also has the service element in that one, in my personal opinion, it's not material to separate the service component from the lease rental for the vehicle. But if you have an aircraft, then the service element is really massive. It's very, very huge. Yeah. So far with me, maybe too boring. Okay. Okay, so now let us have a look on, so I think as I said, yeah, identifying an asset is very, very important. Now the second thing is like more about what should be in the lease liability and how we really determine the value of a lease liability. It's like conventional approach, still there in many of the other accounting standards. So nothing new in that one. Basically, you need three things: lease term, lease payments, discount rate. You need to apply simply the present value techniques, and you arrive on a certain value for the lease liability. Yeah. The technical challenge, I must say, are, pardon me, I need to refer to my notes so that I don't miss anything. Just one practical tip, yeah, always give due consideration to the timing of the lease payments, yeah, when you're discounting. Sometimes it can also happen that the lease payments are paid in advance, yeah, then the discounting will be year -1. This was the mistake which I've seen in many lease contracts when we were entering and we were consolidating the lease contracts. This was one of the mistakes, yeah, so just a practical tip. Okay, so lease term, what do we mean by lease term? So it's very much aligned with IAS 16 that when the asset is available for use, you start the lease term from then, yeah, not from the date of the signing of the agreement, when the real asset is made available for use, yeah, and it goes up to the non-cancelable period. Then, yeah, just the same repetition of the same thing, like what is the non-cancelable period? It's like three things there, yeah. First thing is like the real specified lease term, which is referred as non-cancelable period in the lease agreement. Second thing is if there are renewal options, and as a lessee, you already have a strong indication and a strong somehow intention to renews the lease contract, then that also has to be considered in the lease term. And third thing is like options to terminate for an early termination. So if you already have a decision that you will not exercise that option, that period also has to be considered. So it's more like, I would say it's a common sense in my opinion. It's a common sense, general thing, you know, you have to, as an accountant, as a controller, you have to think, yeah, what should be my lease term, yeah. So basically, if you have an intention to use the asset for longer, then factor that period also in your lease assessment period, yeah. And there are different indicators also which have been laid down by IASB in IFRS 16, which helps the accountants to establish that what are the relevant things which an entity has to consider while defining what will be the lease term, yeah. I'm not going to go into too much detail. The only thing is like there are certain factors which are very entity specific, there are certain elements which are only contract specific, there are general market conditions as well. For example, if there are significant penalties, then it will be ridiculous to cancel the lease contract earlier, yeah, unless and until you have really some legal reason to do that. For example, also we have to see, yeah, if an entity has a sublease contract, then at least you cannot consider the lease term which is less than that sublease contract, yeah. So these are simple common sense indicators, yeah, which we have to always keep in mind. Then if the lease rates are lower than the market rate, also it will not make sense for the lessee to cancel the contract, right? Okay, so other thing which is also very important, which IASB has laid down in IFRS 16 is the legal enforceability. Okay, I have some experience from Gulf, yeah. So I was in Dubai for 7 years working for PwC and also shortly for DHL as well. And one of the real challenges there were like, if you enter a lease contract there, yeah, it was always for 1 year with the renewal options with 3 months notice, yeah. And even the office leases were with 1 year leases. And you put lots of leasehold improvements, yeah. So it will be a bit challenging situation for the people who are somehow to take a decision in the Gulf countries, yeah. Unfortunately, because then auditors can question, yeah, that you have leasehold improvements which are depreciated over a period of 5 years, but the lease or contract legal enforceability is only 1 year. Yeah, for us we were lucky, yeah. In Europe, most of these things are very much streamlined. You have real legal contracts, you know, with the right level of rights and obligations. So it was not a bit of challenge, but it reminded me of my time when I was in Dubai, that can be a real challenge. I'm not sure how it is somehow in Pakistan, but yeah, in Gulf countries it can be a bit of challenge. If it's only lessee, then there are certain elements which we have to consider, yeah, that what will be the good incentive, economic incentive for the lessee to cancel the contract, yeah, or to renew the contract. Okay, lease term, clear? Okay, no answer is like yes, maybe. Other important aspect is the borrowing rate or the discount rate. So you have the lease payments, you have the lease term. Lease payments are also not so difficult to determine when you have the lease term. Yeah, it's linked to your lease contract. The other challenge, at least for the multinationals, is the borrowing rate, the discount rate on which this liability has to be discounted. It may appear very simple. It may appear very simple, but in practical terms, it can be a big challenge. Okay, how many of you remember the criteria laid down in IAS 17 on discounting or on assessing if it's a finance lease or not when you try to compare the future minimum lease payments, discounted value with the fair value of the asset? How many of you do remember still this IAS 17 requirement? Raise your hands, please. Only one? Two? No way. Please, come on. IAS 17 is not new. IAS 17 is not new. Okay, the key message here is somehow multinational groups, IASB is more of the opinion that they can use the implicit rate in the lease contract if it's readily available, and it has to be lower than the internal borrowing rate for the group or for the company.